Andrew, I'll kick it off with you. You think that we're seeing an economic recovery right now, and you're pointing to commodity prices, and I'm wondering what this means for stocks in that second quarter earnings are expected to be terrible, and we are coincidentally hitting new record highs.
I think it's a great setup for many stocks, right? You always want to go into earnings season with low expectations. And so I think you have a number of value stocks out there that the expectation is bad. But some of the economic data has actually improved and been better than what economists predicted. And yet earnings estimates haven't followed the better than expected economic data. So I think you have a setup for a lot of stocks where low expectations going into earnings season is great. That's not true of many of the NASDAQ stocks. So I think they're much more vulnerable because expectations are sky high for those stocks. So you have a very bifurcated market. You always want low expectations for your stocks going into earnings season.
Right, but you're more focused on value stocks in terms of building your portfolio around those, or do you have positions in the high flyers like a Tesla and Microsoft as well?
Well, I think, look, I'm a core manager, and we're slowly moving our bias more towards value stocks, because the reality is that coming out of recessions, you can make a lot of money in these cyclical early cycle stocks. They're anxious. They've had a pullback recently, which is a great setup. But that's when you make your biggest money in value stocks, is coming out of recession. That's what happened in 2009. That happened what happened in the year 2000. The flip side is you have expensive stocks, sky-high valuations. People are huddled in them. And I think they're getting to a level they were in the year 2000 before the bubble burst. So you have a very, very big spread between the reopening stocks and the NASDAQ.
Dion, the S&P 500 is positive for the year. The NASDAQ hit a fresh intraday record high in yesterday's session. Are the markets looking past right now? I mean, the November elections are right around the corner, and we do have increasing tensions with China with the ordered closure of the Chinese consulate, in Houston, that the markets don't seem to be really factoring in or worried about.
Yeah, the markets don't seem to be factoring in just about any of these kind of real-world fundamental pictures. You talked about earnings down. I think expectations are down 44% this year, worse since 2009. You talk about the trade war with China, which is actually in a worse place now than it was really at any point in 2018 and 2019, when this story drove the market just about every day. You talk about the election risk, as you say. Joe Biden with a pretty significant lead growing in the polls on President Trump. That likely means higher taxes, more regulation. And you're even seeing fund managers in my inbox just about every day talking about this so-called blue wave, which would really give Biden the opportunity to raise some of those taxes. And so when you talk about where the market is, certainly right now, folks are really disregarding all those fundamental factors and just kind of playing on, I think, expectations for more stimulus from the government, more action from the Fed should the S&P 500 go down. It is hard to make a fundamental story, especially when you look at the EPS of the NASDAQ and where that is on a PE ratio level. And really, the S&P is up there as well.